Retail capital and institutional momentum behind AI infrastructure have pushed U.S. equities to historic highs, concentrating liquidity into a narrow band of tech stocks. The prevailing market consensus suggests that massive capital expenditures into this tech infrastructure will fuel a multi-year growth cycle for equities. While the surface price action on the left looks robust, the structural mechanics on the right, hedge fund net exposure and corporate issuance data, show a severe divergence from the price. Data from prime brokerage accounts indicates that institutional smart money is already shifting strategies, quietly positioning against the retail-driven flow. To understand this rotation, we must examine three specific pillars of market microstructure: algorithmic sell thresholds, corporate finance constraints, and cross-asset currency pairs. Synthesizing these data points allows for the mapping of a structural liquidity transition before it reflects in broad index prices. Tracking hidden market plumbing and institutional flow provides a mathematical edge that reacting to surface-level news simply cannot match. Commodity trading advisors, or CTA funds, drive significant market momentum using automated systems that operate on rigid, pre-programmed trend thresholds. Institutional models map these algorithms to identify the specific price levels that trigger automated selling across short, medium, and long-term horizons. This 6-month chart shows the S&P 500 resting within 1% of its primary short-term algorithmic sell threshold. By adding a volume profile to the y-axis, we can see the historical distribution of trades at every price level. High volume nodes typically provide the structural support needed to halt a decline. However, looking directly beneath the current CTA threshold, we find a volume air pocket, a cliff edge where almost no historical trading has occurred. In these low-volume zones, there is a lack of resting buy orders to absorb a sudden influx of automated sell volume. If a minor dip triggers that initial threshold, the automated selling can push the index through the volume void, potentially triggering medium-term thresholds in a rapid feedback loop. Crossing into this volume void risks a cascading sell-off, exposing the underlying fragility of the current market structure. The fundamental cycle. Traditionally, tech companies have funded this level of expansion through cheap debt, but as debt capacities reach their limits and bank lending tightens, these companies are pivoting toward issuing new shares of stock to raise the necessary capital. Prime brokerage data reveals that hedge funds are already unwinding long positions in the Magnificent Seven, with net exposure dropping to one-year lows ahead of the next earnings cycle. Smart money is using these mega-cap tech stocks as a source of funds to reinvest elsewhere, which effectively drains liquidity from the market's primary leaders. For the last decade, corporate buybacks have provided a consistent floor for equity demand, but as we see here, that dynamic is shifting. The projected volume of new stock issuance, combined with expiring insider lockups, is on pace to exceed the demand generated by buybacks. Mathematically, when a company issues more shares than it retires, it creates a supply and demand mismatch that requires constant new outside capital just to maintain current price levels. This pivot to equity-funded spending alters the market's math, converting the AI boom from a driver of equity demand into a significant source of equity supply. Beyond equity microstructure, macro cross-asset indicators serve as early warning systems for shifts in global liquidity. The US dollar index has failed to break down further, finding consistent buyers at the 101 support level. A strengthening dollar, particularly a breakout toward the 107 range, acts as a contractionary signal for global risk assets. In the middle pane, the VIX shows a similar floor at the 16 level, suggesting that despite higher equity prices, market participants are consistently buying downside protection. This behavior indicates that institutional players are positioning for a potential spike in market turbulence. In foreign exchange, the Australian dollar to Japanese yen pair is a highly sensitive proxy for global risk appetite. Historically, a breakdown in the AUD-JPY pair below the 110 threshold correlates with definitive tops in the equity market. A strengthening dollar, a rising floor in volatility, and weakening risk proxy currencies independently confirm the structural vulnerabilities found in the equity data. Capital in global markets does not simply disappear during a regime shift. It rotates based on risk and probability models. Combining the algorithmic sell triggers, the surge in equity issuance, and the dollar breakout creates a unified model for a transition into a risk-off regime. A market resting on an algorithmic cliff edge while facing an influx of share supply and a strengthening dollar creates a high probability for a capital transition away from equities. Institutional models anticipate that the Federal Reserve will eventually respond to this structural contraction by cutting front-end interest rates. Long-duration U.S. Treasuries typically act as the recipient of this rotating capital. Going long on the yield curve serves as a hedge against the lag in Federal Reserve policy as market plumbing tightens. Market edges are found by modeling the intersection of algorithmic positioning, corporate finance, and macro flows, rather than simply following surface price action.